Stop worrying so much about asset allocation in your retirement planning. It's We're going to dive into an article by Joe Tomlinson from Advisor Perspectives. Big fan of Joe, and I've been reading him for a long time. And it's a good article, man. No other way around that. And he will make the claim, the case better than I can with actual numbers. And Joe's an actuary by trade. So let's go into this. Let's see. Here's his article right here, and this is Dateline, August 30th, 31st, 2020. And there's Joe. I get this a lot. And apparently Joe does too. It's like, should I be 60, 40, 75, 25 and stuff like that? Actually, before I jump in that, let me just show you my right capital. All right, so here's what I use in a portfolio. So if we go to 100% stocks, this is a total stock market, just U.S. stocks. You see an average annual return of 6.5% with a standard deviation of 17.3. All right. Now that's gross before inflation, so that's not a real return. If we go to bonds, all bonds, we see an average annual return of 2.1 with a standard deviation of 4.6. If we go to a balanced portfolio of 50-50, we'll see an average return of 4.5 with a standard deviation of 8.8. Now, the reason I'm pointing this out is at the end of the day, once you're above 50% over bonds, it doesn't make that much difference between moderate. We got 5% rate of return with a 15% more standard deviation. Growth, we got a 70-30, 5.5. So it goes 4.5, 5, 5.5. In terms of retirement planning, it doesn't matter that much because we're in the decumulation phase, not the accumulation phase. So we're not getting the benefit of compounding interest because we're pulling money out. It just doesn't matter that much. Now, if you want to go to conservative, was that 2080? That's 35. Preservation is 2080. It's going to make a big difference because here you're not even beating inflation taxes. You're only getting 2.9%. But here, again, well, we are having standard deviation, so you're not getting a linear rate of return. But when you're pulling money out, it just doesn't matter that much. So let's read Joe's article. Big fan, first time, long time. So earlier this year, Jeremy Siegel said that 75-25 is the new 60-40. However, what matters for investors saving for retirement, and I would say actually reducing their portfolio because of retirement, is not the asset class performance, but how those translate into consumption for retirement. To examine the impact of stock allocations, I'll focus on retirement planning and show impacts on both the average and variable rate of retirement withdrawals. Spoiler alert, as the title hints, 75-25 versus 60-40 don't matter much. I completely agree. The importance of asset allocation received a boost from a 1980s paper from Brinson Hood Biebauer, which many interpreted as proving that the key to your returns was a stock bond mix and not this stock selection or asset selection or security selection. That's called the Brinson study. And you may remember when I was interviewing Michael Edison last week, he knows one of those guys. I think Biebauer, I think. Was it Biebauer? He knew one of those three. It wasn't Brinson, though. He might have known him, too. But one of those guys was a acclaimed physicist. And Edison says, man, this was shoddy work, man, shoddy math. He told one of the authors of the Brinson study. He goes, all the insane math that you do into the physicist department, you go to finance and you're kind of throwing together something rather shoddy. To which the other guy kind of acknowledged, yeah, it wasn't my best, but be it as it may, it did serve a purpose. And I actually still, I don't know the whole math behind it, but I still like the idea. It says, look, man, what matters most is how much stocks versus bonds versus cash you have. It does. Now, what a lot of people interpret that is it doesn't matter what security you select. It just depends that you're on stocks. I could not argue more. If you bought Amazon in 2000 or you bought Pets.com in 2000, they're both stocks. But one did well, one did not. So security selection does matter. I've never understood the idea of these people say, it doesn't matter what, as long as you have stocks. Okay. All right, so I'll use an example of a retirement-age couple with 30-year planning horizon and $1 million in savings. They're trying to decide between a 60-40 portfolio or a 75-25 portfolio. A key assumption of modern retirement outcomes is the future average stock returns. The size of the assumed equity return premium of stocks over bonds will directly impact the sensitivity of retirement outcomes to different asset allocations. So what that means is a lot of times people say, look, this is where James Glassman got in trouble in the late 90s when he said Dow 30,000. He was right, actually, but he says the historical equity premium of over bonds has been, I forgot what it was. I think it's 6%. Yeah, I think it's 6%. He says if you factor in a 6% equity premium, we should have the Dow 30,000 at some point in the future, in the relatively near future, whatever that was. I can't remember what he said, but it made sense. You're saying historically, the equity premium over bonds should be this, and as such, we should have a Dow 30,000. I'm not so sure I fall for the equity premium over stocks over bonds as much. I actually follow the Vanguard, the BOGA model, which your stock returns are dividend yield plus earnings growth year over year. That's it. Dividend yield plus earnings growth year over year. You plus those two, you get your future expected rate of returns historically, and that has been spot on. I think that's not a whole lot to do with equity premium or over bonds. But with that said, what happens is if there is a bond yield that is so low that you're going to have more people buying stocks because the bond yields are so low, you're going to have more of a PE, the price relative to earnings. But that's just that could be a fleeting. So you got dividends yield plus earnings growth year over year plus the difference in basically the metrics of price to earnings ratio. So an increase in PE ratio would give you a higher rate of return. A decrease in PE ratio would give you a lower rate of return. What causes PE ratio is the demand for stocks. If the demand for stocks is higher because interest rates are lower, inherently you should get a higher rate of return than just dividend yield plus earnings growth year over year. And that's what we've been seeing the last, basically the last 15 years or so, with interest rates being so low, with increasing PE ratio. So I think there's something to be said for that, but that's fleeting because you just don't know what that's going to be. I mean, that could change immediately the minute the demand lessens because people are worried about stocks being overvalued. Anyway, so Christine Benz of Morningstar provided a summary of predictions by various firms, and you can see this is real returns. So BlackRock has 7.2, real is factoring inflation. Here is Vanguard 4.2. That's almost spot on to what I was. Remember, I said if we look at 100% stocks, we got 6.5% rate of return. You factor in 2% inflation, which as I do, that gives us 4.5 real return. And that's pretty much what Vanguard used. Jeremy Grantham's GMO, negative 3.1. They've been bearish for years and years and years and years because he thinks the world's going to die in a ball of climate change-induced fire. Yet he still flies all around the world. I find that odd. All right. Also, what does my man do? Let's see here. So these forecasts all assume a lower than historical average rate of return. These are forecasts for the U.S., and some of the forecasters also assume that higher equity returns may be found internationally, or that returns after 10 years may be somewhat higher. I'm just saying these returns I'm going to put extrapolate for the 30 year, the duration of your retirement. For my analysis, I'll use an estimated real arithmetic average equity return of 5%, but I'll also include a separate analysis based on 7.5%, which is slightly above the most optimistic data set. I'll also assume a 16% standard deviation for stocks based on the Ibsen Morningstar data since 1980. And notice what I use for stocks is a 17.3. So I'm using a 6.5% rate of return with a higher standard deviation than what Joe is. All right, so what he's doing here, so results, 5% average equity return with that standard deviation. He's just running a good old-fashioned Monte Carlo. I show result, he's using an equity return premium of 4%. So basically you got 5% average rate of return minus 1% for stocks. That's a 4%, 1% for bonds. That's a 4% equity risk premium. I just don't like the equity risk premium thing. But anyway, besides stock bond allocations of 60, 40, and 75, 25, I also bracket with 30, 70, and 100% stocks. For each allocation, I ran 5,000 Monte Carlo scenarios. All right, so here we go. We got the median is the blue, and you can see the median distribution yield. What you could take is for a 30-70, you could take about 40,000 a year for 30 years between the 25 and 75% ranges. All right, the median that you could take with a 60-40 is, what's that, about 48,000. The median you could take with a 70 525 is 49,000. The median you could take with 100% is 52,000. Now he says don't focus so much on the median, focus more on the 25%. This band right here, and I get that, but I mean look at the difference between the 60-40 and 75-25. Not much difference, not much difference at all. Now I'd even argue look at the difference between the 100%. The down mark on 100% is almost identical to the down mark on a 75-25 and just a little bit down than a 60-40, whereas the up mark is much higher. Interesting, huh? So look, you can see the low return on the band of 75% to 25 to 75%, the low return on all these things are pretty within spitting distance. We got 37,500, 38,000, and I guess that's 39,000 or something like that. But the high end is significantly different. So 75-25, they give you roughly the same negative on the downside, but much higher on the upside. 100% gives you the same negative roughly on the down, but much higher on the upside. Now the median is pretty doggone close within spitting distance. Now here's a 30-70, good boy, Pablo. So you're getting a lot less potential on the upside, significant less median income, but a lot less volatility on the 25 to 75 as well. What does that tell? It tells me why even be on the. If you're going to be at least 50% stocks, you might as well be. I mean, I'm telling you, might as well just be 100% stocks with enough money in cash to ride through the negative years. That is what that tells me. These projections show median average expected real withdrawals between 45,000. 25 to okay, this is 60-40. So we got a 45,000 as a median, 37,000 right there, and 56,000 right there. All right. We look at let's see, we're going to 75-25 is the increase in the median of less than $3,000. So the median from going 60-40 to 75-25 is not that much. Some would say it's not that much worth the risk, or I'd say it's not that much worth the conservative side of it, if you will, to protect it. Let's see, the range is now okay, but the range is 38,000 to 61,000. All right, where the range before was 37.4 to 55. This is 38 to 61. All right, let's go to 100%. Does he say 100% here? Let's see. All right, let's keep going. I guess he doesn't say 100%. All right, but anyway, I guess we could figure that one out. But you can see, look at that. So if that's 37.4, that's 38. Basically, the range on the downside, about the money you could take out was, basically 39,000. But on the positive side, you could take out, 75,000. I mean, that's pretty good. Adverse year-to-year changes. The chart below focuses on downside volatility, compares the 60-40 to 75-25. So you can see the 60-40. Look at that. So this is the 60-40. So the 60-40 is the blue dash. The 75-25 is the red dash. This is basically the same. I mean, it's just basically the same. All right, results 7.5% average equity return. So that's a 5%, which is lower than what I'm using. A 7.5%, is going to be a much wider berth here. Now, look, here you got 60-40, and this is higher than most people project. But, again, what if we're wrong? So here's a 60-40. You got about 58,000, 62,000, and 75,000. So significant difference on the upside for more stocks. And inherently that makes sense because you got a higher rate of return. There's no other way around that. But again, it's not that. But look at the negative here. The negative here is 54,000. The negative here is 48,000. Negative there is about 45. I think if you're going to have stocks, at least 50% of your portfolio, you might as well shoot for the moon and just keep the other in cash. That's my barbell for sure. This casts doubts on asset allocation and raises related question about rebalancing and the use of non-level asset allocation guide paths during retirement. If the 60-40 versus 75-25 doesn't make much sense, the allocation bouncing around or deliberately shifting within this range doesn't matter much either. The wide variation of average withdrawal levels from 60-40 to 75-25 highlights the importance of a solid base of secure lifetime income to pay for essential expenses. 100% right. Relying on stock-heavy portfolios to meet basic needs carries a lot of risk. I could not agree with that. And then he talks about the median bequest. We're just going to do the 60-40 and 75-25. Not a lot. 75-25 does actually $2.25 million versus that's $500,000 more on the high end and not much lower on the low end. So if you're trying to leave more money, you just have to more stocks. Is no other way around that. Yeah. Conclusion. Most retirement research attempts to fine-tune decision parameters, whereas I point things in the opposite direction, asset allocation. For those targeting significant equity allocations, I've shown the impact of fine-tuning the stock-bond mix gets swamped by the wide range of potential outcomes. To some extent, this result reflects an assumption of lower than historical equity return premium. The study also highlights that high equity allocations go hand in hand with significant uncertainty in retirement cash flows and highlight the importance to secure a sustainable lifetime income to support essentials. Yep. I could not agree more. I'm telling you, man, I just so convinced of the barbell. 4 years of cash and Ginnie Mae, and the rest in VTI. Be done with it. I could not. I could not make that simpler. Just be done. Stop the allocate. I need that asset allocation. I'm 5% more stocks than I should be. Makes my head spin. All right. I'd like to hear your thoughts. We'll see you.